The second valuation methodology that we're going to cover is precedent transactions, also known as transaction comps. And both this precedent transaction and trading comps are fundamental to any valuation analysis that you're going to engage in. To provide some definition around precedent transactions, this is similarly an intrinsic method of valuation. But in this case, we're calculating a company's value based on implied multiples and premiums paid for comparable companies in recent M&A transactions. So whereas trading comps, you can look to public market data, you can see down to the second what price they're trading at and how their valuation is changing. Precedent transactions tend to be a little bit more fixed at certain points in times when the company transacted, when a company sold, or a buyer engaged them. Now, a couple of key themes we're going to see here is that we're deriving a range of valuation multiples based on M&A for similar companies in the past. So a key thing here is we're trying to look at companies in a similar line of business with similar characteristics of the target company that we are trying to value. And again, we're also going to get a wide range of multiples because this will be over periods of time, under different market conditions, under different debt environments and leverage environments. So the characteristics of the market can be different. So you guys are going to find there's quite a bit of science, but more importantly, some art in really determining what an appropriate value is. Furthermore, another key theme will be control and control premiums. Now, a key characteristic of precedent transactions versus trading comps is that this is an M&A type of transaction. So in order for the buyer to win the bid, they need to offer, especially if this is a public company, they need to offer some premium to the existing share price in order to acquire that business. So this is why there's a premium relative to control. You should have to pay a premium rather than owning a single share. You're sort of a drop in the ocean with a publicly traded company or a small percentage of the ownership. You can barely move the needle. We tend to say if you have full control over a company, that should command some sort of a premium because you can make many more of the decisions. You have a larger seat at the table. Now, a final theme we're going to see with precedent transactions is also synergies. Since we have one company acquiring another company, you may often see back office synergies. You may see synergies in the form of revenue from upsell as well, where you're upselling or cross-selling products. There can be many stated synergies in a transaction. So there can be sort of the stated multiple based on the LTM EBITDA, and then there can be sort of a synergized multiple for a business. You can look at adjusted EBITDA based on purported synergies that will be accomplished in a deal and arrive at an adjusted or pro forma multiple. So again, similar to our trading comps, we're also going to walk through the theory behind precedent transactions and then apply this knowledge in an actual case study focused on Nike by benchmarking its valuation to different competitors such as Lululemon, Under Armour, to understand trading comps and precedent transactions.